Do you have any explanation? B, right? Why do we have B is correct? Do you have any idea? So, what is the formula that connect the present value with the future value of something? We have this one. We have present value, for example, of perpetuity, right? Is going to be equal the future value divided by the interest rate. Okay, so if the interest rate go up, then the present value will go down. You see, right? So that's why we have the B. B is the correct answer for the question number 1. Right. Now the second question. The opportunity cost of receiving $10 in the future as opposed to getting the 10 today is, right? So, yeah, that's correct. It's A, the foregone interest that could be earned if you had the money today, right? So if you have the money today, you have to forget about the interest rate, right? And that's why people say that the interest rate is the opportunity cost of holding money. Now is the third question. We have a table. And they ask you, what is the marginal revenue of producing the third unit? The third unit. Huh? What is the marginal revenue of producing the third unit? Yeah, that's correct. It's 70. How do we compute? You can see that at the third unit, it will get 250, right? So if you move from the second to the third, you will have an increase of 250 minus 180, and it is going to be equal 70. Yeah, and this one is the marginal. We say it is the marginal revenue of producing the third unit. All right, that's good. Now the fourth one, the fourth question. Given the cost function, what is the marginal cost? D. D, right? That's correct. D. Because we know that the marginal cost is the derivative of the total cost, right? Of the total cost, right? Now the fifth, in the famous book, The Wealth of Nation, Adam Smith gave that. Do you know it? Yeah, make a guess. What is the key point of Adam Smith? Recall that the key point is that Adam Smith said that he believed that the free market would be efficient for resources allocation. So what do you think? A, B, C, or D? Yeah, that's correct. Right. Yeah. The key point, the key argument of Adam Smith is that all people are self-interest, okay, and the market is an invisible hand that coordinate people and lead to efficient allocation of resources. Right? This question number 6. If the interest rate is 5%, 100 received at the end of 7 years is worth how much today?
B.
B, that's correct, right? You take 100 divided by 1 plus 0.05 to the power of 7. All right, that's correct, because we have 7 years, right? Now the question number 7. Maximizing the total benefit is equivalent to maximizing net benefit. Yeah. Here we have total benefit, here we have net benefit. If and only if there are A, the constant marginal cost associated with achieving more benefit, B, no cost, C, increasing cost, D, decreasing cost. Not very easy question. What do you think? Recall that they ask you about when, yeah, under which condition we have the problems of maximizing total benefit is equivalent to the problems of maximizing net benefit. Now recall that you have net benefit is equal total benefit minus total cost. Yeah. So under which condition we have the problems of maximizing total benefit is the problems of maximizing net benefit. What do you think?
No cost, B.
Yeah, that's correct. The correct answer is no cost associated with achieving more benefit. All right. So let me give you an example. Suppose you can drink water for free. Okay? You can drink water for free without having to pay. Right. It is a case when maximizing the total benefit is equivalent to maximizing the net benefit if you do not have to pay to drink water. All right. Now the question 8. Because of producer rivalry, the price will tend to, what do you think? Take a look at the question. I have phone call and I'll be back, right? Vâng. Vâng ạ. All right. Sorry. Yeah, I'm back. Right. Sorry. Right. Let's go back with. So, do we have the answer for the question number 8? Right. So we know that due to the impact of the producer rivalry, we have the effect that the price is going to be lower. The price is going to be lower. Now, what about the question number 9? Pay attention on the fact that they ask you property owners move scarce resources toward the production of goods most valued by society because you can see that the option of B and D is quite going to be confusing, right? But the correct one is going to be B. The consumer will demand inexpensive goods, so the producer will have to find the most efficient way, right, to utilize resources. Right. Now the last one, the question 10, number 10. The opportunity cost of an action is, right?
B.
Is B, right? Is the value of most highly valued alternative action that was given up. It's very important that it is not to be too confused with the option of C. It is not the cost of all alternative. Yeah, it is only the cost of the most highly valued alternative option, right? So that's good. Now let's go through the textbook problems. We have number 3, 6, 8, 12, and 17. Right? Let me open it. Here it is. Here's the textbook. All right. And here's the question through number 3. Sorry. The question number 3. You have they ask you the following. Suppose that the total benefit and the total cost from a continuous activity are respectively given by the following equation. So this one, it is the benefit function. This one is the cost function. All right. And question A, write down the equation for the net benefit. So someone tell me please how we can derive the net benefit. What is the formula for net benefit? Yeah, that's correct. It is equal the benefit subtract the total cost, right? That's good. So for the question B, you can see that it is pretty simple. If you can derive the net benefit function, they ask you what are the net benefit when Q equal 1 and Q equal to 5. So if that's plug in, yeah, the information of 1 and the information about Q equal 5 into the net benefit function, and we can easily get the answer for this question. Now the question C. They ask you about the equation for the marginal net benefit. Yeah, recall that marginal net benefit is M and B, right? What is the formula for marginal net benefit that we have?
Marginal benefit minus marginal cost.
Yeah, pretty good. It is MB minus MC. That's good, right? So based on the given information, you can see that here is the marginal benefit, here is the marginal cost, and we can easily write out the equation for marginal net benefit. Okay, so it leads to the question D, and once again, it's pretty simple. They ask you about the marginal net benefit when Q equal 1 and Q equal 5. We simply plug in, right? Once again, we plug in the equation, right? Now the question of E, they ask you about the level of Q that maximize the net benefit. So what is the condition when we have the net benefit to be maximized? Tell me, please. Yeah, that's correct. When we have MB equal MC, or in other words, we say when the marginal net benefit equal to 0. Okay, equal to 0. Right, so that's good. Now the question number 6. Question number 6. They ask you to complete the information and answering the two questions A and B. All right, A and B. In general, you can see that in this table, they give you full information about the total benefit, full information about the marginal cost, and you have to fill out on the remaining cells in this table, right? Do you have any idea on this? How will you fill this table? So for example, what do we have if we want to fill the table for net benefit? Of course, it will be equal B minus C, yeah? Okay? See it? All right. How will you compute the marginal benefit? What do you think? How would you compute the marginal benefit and B? Yeah, yeah, that's correct. Yeah, you can see that the marginal benefit is the change in the total benefit when we change the control variable. Yeah, you can see it. Well, suppose we change the Q from 100 to 101, then the total benefit, right, increase from 1,200 to 1,400, and we say that the marginal benefit of the last unit, yeah, the 101st unit, is 1,400 minus 1,200, so it is 200, and next it is going to be 1,590 minus 1,400, so it is 190, and so on. Okay, pretty simple. Now, what about the marginal, the total cost? How will you fill out the column of total cost?
Based on a marginal cost.
Based on marginal cost and yeah, the initial number of total cost. See, right? So, for example, if we want to fill the total cost at the quantity of 101, you take 950 plus 70. See it? Right? So it is going to be 1,040. 20. All right, see. The next point, for example, 102, yeah, 1020 plus 80. Okay, so it is going to be 1100. Okay, and so on. All right. Now what? And based on the BQ and CQ, you can compute the net benefit. Okay, so for example, it is 1200 minus 950. Okay, so it is 150. Sorry, 250. Right? Here we have, it is going to be 280. Right, and so on. Now about the last column, the marginal net benefit. Okay, recall that we have the marginal net benefit equal the marginal benefit minus the marginal cost. See it, right? So here we have 150. Here we have 130. Understand? You got it? Right?
Yes.
The next point is 190 minus 80, so 1 and 10, and so on. Okay? So, of course, after filling out all of the cells in this table, you can easily answer the question A and question B. Yeah, for example, they ask you in the question A, at what level the control variable, yeah, here we have control variable is Q, the net benefit is maximized. So the net benefit is maximized. You will take a look at this column, yeah, and you will find out, right? Okay, now the question number 8. Here it is. Number 8. It say that Janet spent $30,000 per year on painting supply and storage space. She recently received 2 job offers from a famous marketing firms. Right? One offer was for 110 per year. Another one was for 80,000. However, she turned both the job down to continue a painting career. If Janet sell, let's say, 25 paintings per year at the price of 8,000 of each, and they ask you 2 questions: A, what are her accounting profit? And B, what are her economic profit? So, question A. What do you think? How we solve the question of A?
I take the total revenue she can earn from sell painting minus the cost they spend on supply and storage space, 30,000.
Yeah, that's correct. Yeah. So accounting profit, yeah, we know that it is equal the revenue, yeah, subtract the explicit cost, right? So what is the revenue for us in this example? It is equal 25 times 8,000. So it is going to be equal $200,000. See it, right? The explicit cost for Janet is going to be 30. All right. So see it. You can see that her accounting profit is $170,000. All right. Now the second question. Now the second question about economic profit. How we compute the economic profit? Recall that you have the economic profit is equal revenue subtract explicit costs, right? And subtract implicit costs. You already know the revenue. You already have information about explicit costs. So what about the implicit cost? How much do we have of implicit cost in our example? What do you think? Yeah, that's correct. So it is the best option, yeah, that she turned down to continue to her painting career. Yeah, it is $110,000, right? So based on our calculation, you can see that the economic profit for Janet is going to be, let's say, $60,000 economic profit, right? That's good. Okay. Now the question number 12. Right? You are in the market for a new refrigerator for your company's launch, and you have narrowed the search down to two models. You know, so we have to choose between the two models. The first one is called the energy efficient model, and the price for this machine is 1,600. The advantage of this machine is that it will give you $40. Sorry. Hello. All right. So the advantage of the energy efficient model is it saves $40 each year in the next 5 years. So each year you save $40 in electricity costs. Yeah, if you use the so-called energy efficient model. And the second option is that is the standard model. Yeah, it has a feature similar to the energy efficient model, but no saving on electricity. All right, and the price of the standard model is 1,350. Right. Further, you have another piece of information. The opportunity cost of funds is 6%, or in other words, we say the interest rate, yeah, is 6%. And they ask you which refrigerator should you purchase. So what is our problem? You can see that based on the information given, yeah, if you look at the difference in the prices, you can see that the energy efficient model is $250 more than the standard model, right? and it allows you to save 40 in the next 5 years, each year in the next 5 years, right? So actually the number 40 works like a cash flow in next 5 years, right? And the number of 250 work like your investment, the initial investment, right? So what do you think? How will you solve this question? Know it? To solve this question, you should compute the so-called the net present value of the investment, right? The net present value of the investment. And it is equal the future value, the present value of future benefit minus the cost of investment. Understand this point? All right, we have the cost of investment is 250, right? We have to compute the present value of future benefit, the present value of future benefit, and pay attention on the fact that we have 5 years. And each year we have the cash flow of 40. Okay, so the computation is pretty simple. Suppose for the first year, I'm going to draw in this place. Yeah, for the first year, you have 40 divided by 1 plus the interest rate, which is equal to 6%. Right? For the second year, you have 40 once again, divided by 1 plus 0.06 square. Understand this? Do you understand?
Yes.
Right? And so on to the fifth year, you have 40 divided by 1 1 plus 0.06, right, to the power of 5. Okay, so that's it. And I say it is called the present value of future benefit, right? Benefit. Suppose you compute this one. Yeah, I'm not going to do the computation, but suppose that you already compute and get the number, and it is the number of x. Okay, so further you compare this x with $250. Okay, and assume that if x is greater than $250, what kind of model will you purchase? The energy efficient model or the standard model? What do you think? If x is greater than $250, which one would you buy? If the present value of future benefit is greater than the initial investment, yeah, actually it means that the NPV is greater than 0. the net present value is greater than 0, which one would you buy? The energy efficient model or the standard model? So we have what?
Energy efficient.
Yeah, that's correct. You will buy the energy efficient model, right? Otherwise, if X is smaller than 250, yeah, then the choice is to buy the standard model, right? Now let's assume a more tricky question. Suppose you, after the computation, you find out that X is equal to $250. What would be your choice? If X is good, yeah, I'm listening.
Maybe standard.
Not exactly. In this case, if the present value of future benefit exactly equal the net present value, then exactly equal the initial sum of investment, then it means that the NPV is equal to 0, and we can say that you are going to be indifferent. We say you are indifferent, right, of buying the standard model or the energy efficient model. Understand the point? Understand what do I mean when saying you are indifferent? Các em có hiểu khi thầy nói indifferent ở đây nghĩa là gì không nhỉ? Indifferent thì người gọi là bàng quan, tức là không quan tâm đến việc lựa chọn cái mẫu tiết kiệm điện hay là mẫu thông thường. Có hiểu không nhỉ? Tức là mẫu nào cũng được, đúng không? Bởi vì cả hai mẫu nó đều mang lại cái mức lợi ích là như nhau. Ok. Right. Okay. Actually, if you compute, I'm going to give you the answer for this question. If you compute, you will get the following answer for this question. Let me give you the answer for this question. You will find out that the present value of future benefit is going to be equal $168.49. Yeah, so we can see that it is lower than 250, and the answer for this question is that you will buy the standard model. You are going to buy the standard model, right? All right. Now let's move to the last one. The head, number 17, right? The head of accounting department at a major software manufacturer asks you to put together a pro forma statement of the company's value. You have to compute the company's value under several possible growth scenario and assumption that the company's many division will remain a single entity forever. The manager is concerned that despite the fact that the firm's competitor are comparatively small, collectively, their annual revenue growth has exceeded 50% over each of the last 5 years. she has requested that the value projection to be based on the firm's current profit, is a current profit of 3.2 billion, which have yet to be paid out to the stockholders, and the average interest rate over the past 20 years is 6%, right? In each of the following profit growth scenario, ABC. What is the key point of this question? I'm not going to give you the detailed explanation for this question, but the idea is that you have to compute the present value of the firms, right? Given the information about current profit, and the interest rate, and the profit growth rate, right? In the chapter number 1, you have the following formula. It is the present value of the firms equal the current profit times 1 plus I divided by I minus G, right? This one. If G is smaller than I, right? We have this formula for present value of the firm's computation. So pretty simple. You simply plug in all the information and easily compute the profit for the firms. Why they say that the question A is tricky? You know why it is tricky?
The growth rate higher than interest rate.
Yeah, that's correct. This one is tricky because growth rate is greater than I, and we are not going to be applying this formula, not to be applied. All right. So you can compute the present value of the firms using this formula only for the question B, C, and D. Yeah. The question A, because G is greater than I, then this formula is not going to be applied. Okay. So that's it. Do we have any question for the problems in the chapter number 1? Have any question? No? Right. So let's have a break of 10 minutes. Then we'll be back with the chapter number 2. Right. Let's have a break for 10 minutes. Right. All right. Now let's go back. Right? Now we're going to have the chapter number 2. It is about the market forces. Right? And talking about the market, of course, we have to talk about the two forces in the market, the demand side and the supply side. Actually, the most of the material in chapter number 2 have been already covered in the course of microeconomics. So we are going to go through the chapter number 2 quite quickly, right? Here, the key question we are going to look for in the chapter number 2. First, we are going to discuss about the law of demand and law of supply. We are going to identify the factor that shift the demand curve and the supply curve. Okay, hope that you remember it. Then we are going to discuss about consumer surplus, producer surplus, and discuss the meaning. Yeah, why do we care about consumer surplus and producer surplus? Later on, we are going to discuss about the equilibrium. We are going to talk about the effect of tax, effect of price control, like price floor and price ceiling on the functioning of a market, how it affects the market. Right? And lastly, we are going to use the supply-demand framework to qualitatively forecast the market, yeah, to see the big picture of a market, right? Okay, so first of all, let's pay attention on demand. Pretty simple. Here we have the definition of the demand curve, right? The demand curve tells us about the relationship between the total quantity demanded and the price of a good, at which the consumer are willing and able to purchase, holding other variable constant. Yeah. And the law of demand is pretty simple. If the price go up, the quantity demanded will go down. So we say the price and the quantity demanded are inversely related. And that's why we have the demand curve is downward sloping. We have a negative slope of the demand curve, right? So it looks like this. Suppose we have a market, right? Here's the price, here's the quantity, right? We have the following information. When the price is at 30, the quantity is 20. When the price is 20, the quantity is 40. When the price is 10, quantity is 60. So through this dot, right, we can have the demand curve. Is our demand curve, right? And of course, you can see that it is downward sloping. The law of demand tells us that the demand curve is downward sloping. The relationship between price and quantity demanded is negative. Okay. Talking about the demand side, it is very important to distinguish the two terms, the quantity demanded and demand, right? If you have learned microeconomics, I hope that you already know that the change in the price will lead to a change in the quantity demanded. Price change will lead to the change in quantity demanded. All factors other than the price will lead to the change in demand. Okay, so pay attention on the fact that we have quantity demanded Okay, it's slightly different from the concept or the terms of demand. Okay, the price change will lead to the change in quantity demanded, and all other factors will lead to the change in demand. And the change in quantity demanded due to the impact of a price change is illustrated as a movement along the demand curve, right? Along the demand curve. The change in demand is represented graphically as a shift of the demand curve, right? A shift of demand curve. Okay. So on the graph, it looks like this. Suppose we have once again a market, the price, the quantity. Initially, we have here is our initial demand curve, right? Suppose we have point A and point B, right? A movement from point A to point B is due to the change of the price. Yeah, we have when the price decrease, we have a movement from point A to point B, and it tells us that the quantity demanded has been decreased. Has been increased, right? Now, all other factors than price can shift the demand curve. Suppose we have something happen that lead to an increase in demand. On this graph, we say that the demand curve, right, shift rightward or shift to the right. Shift to the right. Yeah, and it tells us about an increase in demand. If something happened that shift the demand curve to the left, then it means that we have a decrease in demand. Okay, shift to the left. Okay, right, shift to the right is an increase. Shift to the left is a decrease. Okay. Now this slide summarize the key demand shifter. The key demand shifter, namely the income, price of related goods, advertising, population, expectation, and so on. Right? The effect of income on demand tell us whenever a good is a normal good or inferior good. Right? Recall that for normal good, we have the relationship between income and demand is positive. Yeah, when income increase, the demand increase. Right? For inferior good, we have the relationship between income and demand is negative. Yeah, so income increase, the demand for good will decrease. So someone please give me some example. Give me some example of inferior good, please. Can you give me some example of inferior good? There are quite a lot of example in real life of inferior good.
maybe store brand.
What? Once again, please. What kind of goods?
Ví dụ như kiểu là mì ăn liền hoặc thực phẩm đông lạnh như này.
You say instant noodle, yeah? Instant noodle, right? Okay, that's correct. Yeah. For example, if when you are a student, you have quite low income, you eat a lot of instant noodle. That's correct. When you finish university, you go to work, you have more income. Yeah, you're going to consume less of instant noodle. Many people believe that rice might be regarded as inferior good. Often the case when our income increase, we are going to consume less quantity of rice. Okay, so pay attention on the fact that there are various example of inferior good around us, right? Now about the price of related goods. Talking about related goods, here we mean by saying the two type, a substitute or complement. Substitute or complement. The substitute case is the situation. Suppose we say X and Y are substitute, right? If the price of Y go up, then the quantity demanded for good X will go up, right? Give me some example, please, of substitute goods.
Coca-Cola với cả Pepsi.
Em nói lại, thầy chưa nghe rõ lắm.
Coca-Cola and Pepsi.
Yeah, that's correct. Coca-Cola and Pepsi-Cola, right? That's good. Yeah, orange and apple, right? They're substitute goods. Complements, X and Y are called complement. If the price of Y increase will lead to a decrease in the quantity demanded for good X. And once again, I want you to give me some example of complements. What do you think? Once again, there are a lot of examples of complements goods.
Like the price of coffee increase, so the quantity demand of milk will decrease.
Yeah.
Because less people buy coffee.
Yeah, coffee and milk, right? You think that coffee and milk? Why?
Because when the price of coffee increase, I think the people buy coffee is less, it lower. So
you mean that drinking coffee is accompanied by drinking milk?
No, component. I don't know.
I understand. Actually, I understand what do you mean. But this is not very good example of complements. Complements is the situation when the use of one good, yeah, is accompanied by the use of another good. Okay, And I think that the most intuitive and easy example of complements is the case of cars and gasoline, right? See it? I say cars and gasoline. Okay, right? You use cars, yeah, and it should run on gasoline, right? Though now some other advertising, yeah. So for example, if firms spend money on advertising, likely that the likely effect is that the demand will increase. Population, all right. So for example, we can see that the real estate price in Vietnam for the last 20 years increased sharply because we have a significant increase in the population in big cities like Hanoi and Ho Chi Minh City and so on, right? The fifth one is the consumer's expectation. Consumer's expectation. Let's take an example. Suppose we have the following. Suppose in the year of 2022, the Vietnamese people expect that their income will increase. Right? So what would happen to the market? What would happen to the demand if people expect their income to increase? What do you think? The demand for normal goods, yeah, for normal goods will increase. You know, often the case, right? Okay. All right, and some other factors, right? Here's an example. Suppose we have a market, and we are going to illustrate the effect of advertising on the demand for clothes, yeah, for clothing. Suppose we have the demand curve. If the firms in this market spend more on advertising, it will shift the demand curve to the right. You know, we're going to have an increase in demand, right, due to the impact of advertising. We can analyze this situation from two perspectives. Right? The first one, you can see that at the given price of 40, due to the impact of advertising, the quantity demanded increased from 50,000 to 60,000. Yeah, at given price, the quantity demanded increased. Right. The second perspective we can take in this example is the fact that a given quantity demanded, 50,000 for example, due to the impact of advertising, people are going to pay more, are willing, yeah, to pay more for the good. Yeah, they're going to pay $50 for clothes at the quantity of 50. Yeah? A given quantity demanded, people are willing to pay more. All right? Tức là gì? Khi mà chúng ta nói về sự gia tăng của cầu thì chúng ta có thể quan sát trên hai cái giác độ. Thứ nhất là với mức giá như cũ thì lượng nhu cầu đã tăng lên. Với mức giá như cũ, lượng nhu cầu tăng lên. Cái giác độ thứ hai mà chúng ta có thể quan sát là với cái lượng nhu cầu như cũ thì khi mà cầu tăng thì nó thể hiện là người tiêu dùng sẽ sẵn sàng trả một cái mức giá cao hơn để mua hàng hóa. Ok. Alright. Now we're going to talk about the demand function. The demand function. A demand function for a good, for example, good X, it is a mathematical representation of how many units would be bought at different prices for good X. The price of related good, income, and other factors that affect the demand for good X. Basically, we have the general formula for demand function is following. Suppose is the quantity demanded for good X. It is a function, right, of the price of good X itself, the price of related goods, right, the income of people, and other factors. Okay. It is our general demand function, right? In economics, we often use the so-called the linear demand function. The linear demand function. It is very simple, but quite useful. We can write down the linear demand function in the following way. Suppose we have QHD is quantity demanded for good X, and we can see that there are 4 variables that affect the quantity demanded for good X, namely Px, Py, M, and H. Right? We have Px is the price of good X, Y is the price of related good, yeah, we could call good Y. M is the level of income of people, and H and other variable, something like advertising, and so on. Right? Here we are going to discuss about the sign of the alpha coefficient. So we can see that we want to answer the question alpha, yeah, alpha coefficient, they are positive, right, or negative, right? Our discussion can be formalized as follow. We have alpha x, we can expect alpha x to be negative, to be smaller than 0. Why? Because the law of demand, right? If the price of good X increase, we expect that the quantity demanded for good X will decrease. Okay. For the alpha Y, we expect that alpha Y to be positive if good Y is a substitute for good X. Yeah, it means that Py increase, the quantity demanded for X will increase. And of course, if X and Y are complement, X and Y are complement, then we expect that alpha Y to be negative. Yeah, the price of good Y increase, the quantity demanded for good X to decrease, right? Now alpha M, we expect that alpha M to be negative if X is an inferior good, and of course we expect that alpha M is positive if X is a normal good. right? Now let's take a look at an example. We have a numerical example, right? Suppose an economic consultant of a corporation, X corporation, they provide the firm's marketing manager the following demand function. Yeah, this one. How they can estimate this demand function? Pretty simple. They collect data. What are the key data? The data about the quantity of sale, the price of the good, the price of related goods, the income of people, and the level of advertising spending. Yeah, they collect data. They run the regression model, right? And it will give them the estimated demand function, right? Now they ask you the following question. How many good X will consumer purchase when PX equal 200, PY equal 15, and M equal 1000, advertising AX equal 2000? Yeah, pretty simple. You can see that you can simply plug in this information and easily compute QHD, right? So the first part of this question is going to be quite easy. Now the second point, are good X and Y substitute or complement? What do you think? If you look at the function, would you please tell me X and Y are substitute or complements? And why? Anyone? Of course, you have to pay attention on the sign of alpha Y. Yeah? Here we have alpha Y is equal to 4. So what does it mean?
It's greater than 0, so E is a substitute for good X.
Yeah, that's correct. We have Y and X are substitute. They are substitute, right? Another next one. The next question. Good X is a normal or inferior good, so you have to pay attention on alpha M. And based on the demand function, you know that alpha M is equal -1. It is equal -1. So, what do you think?
It's lower than 0, so X is inferior. Good.
Yeah, that's correct. We have X is inferior good because when income increase, yeah, the quantity demanded for good X will decrease. Okay, so pretty simple. You can see that based on a very simple demand function, we can make a lot of conclusion. We know that X and Y substitute. We know that X is an inferior good. Okay. All right. Now let's go on to derive the so-called the inverse demand function. The inverse demand function. If we plug in the equation, the information about the price of good Y, the level of income and advertising, we can derive this demand function. QHD equal 6060 minus 3px. Okay. We are going to derive the so-called the inverse demand function. This one, it is the inverse demand function. Why? Because by this way, we can illustrate Px as a function of Qx. Yeah, the price as a function of quantity. Why? Because if you look at the graph, you can see that we have the quantity is on the horizontal axis. Yeah, the price is on the vertical axis. So it is going to be more convenient for us to have the inverse demand function. To have the inverse demand function, right? So here is our inverse demand function. You can see that here is intercept, yeah, which is 2020. Yeah, it is the intercept, and we have here's the slope, here the intercept, right? Now the next point, it is about the consumer surplus. The idea about the consumer surplus is very, very important in marketing. It's very important factor that affect the marketing decision of the company. To discuss about the consumer surplus, we are going to look at the three concepts. The first one is called the total consumer value. It is defined as the sum of the maximum amount that a consumer is willing to pay a different quantity. So let me give you a personal example, right? Suppose you value an iPhone, yeah, you value an iPhone 13 at 25 million Vietnam dollars, right? The second concept is a total expenditure. It is a per unit market price times the number of units consumed. Right? Suppose you have the following. The market price for iPhone 13 is 21 million. Right? You value the iPhone 13 at 25 million. The market price for this item is 21 million. All right. So based on this, you can easily find out your consumer surplus. Yeah, it is going to be equal to 25 minus 21. Right? You can see that you are willing to pay for the iPhone at the price of 25, but you actually have to pay only 21 to get this item. So the consumer surplus of yours is going to be 4 million, right? And that's why we have here here is the definition of consumer surplus. It is the extra value that the consumer derive from a good but do not have to pay for it. Okay, so in general we have the following. We have consumer surplus is equal the total consumer value minus the total expenditure. Right? Here's the key point. Now let's do it graphically. Let's do it graphically. Here's a graph. Here's a market demand. We are going to compute to derive the consumer surplus at a given price level. Suppose we have the price is at 3 and the quantity is at 2. right? Here, this area tell us about the total value, total consumer value. Yeah, you can see that. For example, 5, 0, right? 3, 0, right? And it is equal to 8. What is the expenditure? The expenditure is equal this one, yeah, this gray area, okay, this gray area, this rectangle, okay. You can see that here's the quantity. We simply take the quantity times the price, okay. It is the cost of buying the good, yeah. The quantity sold is 2, and the price at which the good was sold is 3. So the total expenditure is 6, right? So the difference between the consumer value and the total expenditure is the consumer surplus. And in our example, we can see that it is going to be equal to 2, right? And you can see that, I hope that you remember from the course of microeconomics, the consumer surplus is the area below the demand curve and above the price, okay. It is the area below the demand curve and above the price. All right, and the key point is pretty simple. If the price decrease, then the consumer surplus will increase, right? If the price increase, then the consumer surplus will decrease, right? Let's once again look back at the example of an individual. His willingness to pay for the iPhone 13 is equal 25 million. Initially, the price for the iPhone 13 is 21 million, right? And we know that the CS, the consumer surplus for him, is 4 million. If the price go down, for example, discount is going to be applied, right? And the actual price to be paid is only 19 million, right? And we can see that the consumer surplus will increase, and it is going to be 25 minus 19, and it is going to be equal 6 million, okay? All right, understand? So the rule we have here is following. The willingness to pay of the buyer should be greater than the price. Or in other words, if you are a manager of a firm, yeah, you are a manager of a firm, and your task is to set the price. You want to set, suppose we want to set the price, right? You want to set the price. Of course, you should not set the price that is greater than WTP. You should set the price which is lower than WTP. Understand this point? Yeah, you have to learn about the willingness to pay of the buyer and set the price, yeah, to be equal or lower than the WTP of the buyer. Understand? Do you understand? Understand this point? I say that you are a manager of the firms. If you want to set the price, it should be lower or equal to the willingness to pay of your customer. Understand this point?
Yes, understand.
Yes.
Okay, that's good. Now let's turn our discussion on the supply side. Similarly, we have here's the definition of market supply curve. It tells us about the total quantity that producers are going to be produced at each price. Yeah, holding input prices, technology, and other factor constant. And we know that the law of supply is pretty simple because all of us know that the supply curve is upward sloping. So there is a positive relationship between the price and the quantity supply. All right. And once again, it is very important to distinguish the difference between quantity supply and supply. Yeah, the price change will lead to a change in the quantity supply. Factor that other than price will lead to a shift in the supply curve, or we say will lead to changes in supply. Okay, so it looks like this on the graph. Here is the supply curve. From point A to point B, we have a movement along the supply curve, and it happened due to the change in the price, right? If we have a shift of the supply curve to the right, it means we have an increase in supply. Otherwise, if we have a shift of the supply curve to the left, it tells us about a decrease in supply. Right? No, let me give you some example. What can lead to an increase in supply? For example, if the price of input go down, yeah. If we have a technology improvement, yeah, it will increase the supply, right? Here are some of the key supply shifts, namely input prices, technology, government regulation, the number of firms in the market. Now we know that it is very important to recognize that there might be some barrier to entry or exit. Yeah, if firms enter the market, then supply will increase. If firms exit the market, yeah, and then we are going to have a decrease in supply. Okay. Some other factor that shift the supply curve we have is substitute in production, the effect of tax imposed by the government or the expectation of the firms in the market. Right? Now let's take a look at the effect of the tax. Here we are going to distinguish the two types of tax. It is called excise tax and ad valorem tax. Excise tax is the type of tax in which we are going to apply, or we are going to impose, yeah, a tax on each unit of output, or we say per unit tax. Yeah, it is called per unit tax. Let me give you an example. We know that in Vietnam, the goods like gasoline is imposed on the goods of on gasoline. We impose that's so-called the environmental tax. which is roughly about 4,000 Vietnam dong, right, per liters. Right, and this is an example of per unit tax, right? For the case of ad valorem tax, it is the case when we apply percentage tax as on the value of the good, right? On the price of the good. For example, we have ad valorem tax, something like VAT tax. Yeah? It is an example of ad valorem tax. For example, suppose we have VAT tax rate is 10%. Yeah, 10% of the price of the good, right? The effect of excise tax and ad valorem tax would be slightly different if we illustrate on the graph. Here it is, right? Let's say here's an example. S0 is our initial supply curve. Suppose the government apply per unit tax, which is equal 20 cents. On this graph, we have the supply curve shift upward, or we say shift to the left, by the amount of the tax, So we can see that at a given quantity supply, the price is going to be higher by 20 cents, right? Here's a graph, and we are going to illustrate the impact of ad valorem tax. Yeah, ad valorem tax, and remember that it is called the percentage tax, right? It works like the following. Suppose the government imposed the tax of 20%. Yeah, you can see that here is our initial supply curve. The new supply curve is going to be 1.20 times the old supply curve, and on this graph you can see that it looks like the supply curve rotate to the left. Yeah, the supply curve rotate. I say rotate counterclock, right? Counterclockwise. All right, and it means that the size of the tax, is dependent on the quantity. Okay, the size of the tax is dependent on the quantity. The greater the quantity, the larger the size of the tax. Okay. Right. Now let's move on to look at the supply function. Similarly, the supply function tells us about the mathematical representation of the quantity supply at different prices, given some other factor like input prices to be constant, right? And here's our example of linear supply function. We have the following. We have Q equals S. It is the quantity supply of good X, right? There are 4 variables that affect according to this supply function, namely the price of good X. W stands for the price of input. PR stands for the price of technologically related goods, and H is all other factors, right? All right, so let's finish our class of today at this point. Okay, we're going to continue our class on Friday. Right, that's right. Any question?
No.
Okay, so thank you. Let's meet again on Friday. Okay.
See you again. Bye bye teacher.
Rồi. Thì chào các em nha. Hẹn gặp lại các em ở tuần sau.
Chào thầy ạ.
Thầy ạ.
Chào các em.